Money Mules. In 2023, a 28-year-old in Ohio received a message from someone he had been talking to online for 3 months. She said she needed help moving money out of a frozen account. She sent him $45,000 in crypto. He forwarded it to a wallet she provided and kept $3,000 as a fee. He had just laundered money for a criminal organization and had no idea. That is a money mule, not a hacker, just a real person with a clean bank account and a legitimate identity, recruited through a romance scam, a fake job posting, or a social media ad for a payment processing role. This matters to you because the recruitment happens on the same platforms you use every day: LinkedIn, Instagram, Tinder. The offer looks like a side hustle. The consequences look like a federal charge. The reason it works is simple. Automated detection systems flag suspicious wallets and suspicious patterns. A first-time account holder with no criminal history registers as clean. The dirty money enters the financial system wearing a completely innocent face. The criminal stays invisible. The mule absorbs all the legal exposure. Cryptocurrency mixers. Every transaction on a public blockchain is visible to anyone. That transparency is the single biggest threat to a digital launderer, and mixers exist specifically to destroy it. A cryptocurrency mixer pools funds from multiple users, scrambles them, and sends equivalent amounts back out to completely fresh addresses. The direct link between who sent the money and who received it is gone. Think of it like pouring several different drinks into one shaker, rattling it hard, and pouring them back into new glasses. Nobody can tell which liquid came from which bottle. This matters to you because when a mixer processes stolen funds, the cleaned money eventually re-enters the same exchanges and wallets that ordinary people use. In August 2022, the US Treasury sanctioned Tornado Cash after it was used to launder over $455 million linked to North Korea's Lazarus Group. That money funded weapons programs. The mixer had no server to seize, no operator to arrest. It ran on mathematics, and anyone with a crypto wallet could access it. Chain hopping. A hacker steals $190 million in cryptocurrency. It is sitting in a wallet on the Ethereum blockchain, and every forensic firm in the world can see exactly where it came from. So they move it, not to a bank account, to a completely different blockchain, then another, then another. Think of a fugitive crossing 6 different countries using a different passport and a different mode of transport at every border. A train in one country, a boat in the next, a cargo flight in the third. Each border authority only sees one leg of the journey. Nobody sees the whole picture. This matters to you because the bridges used to move dirty money are the same bridges ordinary crypto users rely on to transfer their own assets between networks. When a bridge gets exploited or sanctioned as a result of criminal activity, legitimate users lose access too. By 2025, forensic firms confirmed over $21 billion had been laundered through cross-chain services. The infrastructure criminals abuse is the same infrastructure everyone else depends on. Behavioral evasion. Modern blockchain forensics does not just blacklist known criminal wallets. Companies like Chainalysis and TRM Labs map behavioral signatures, the timing of transfers, the gaps between transactions, the specific pattern of how addresses connect to each other. They are not looking for a name, they are looking for a rhythm. So sophisticated launderers stopped having a rhythm. They built automated bots that mimic legitimate high-volume traders, flooding their illicit flows with thousands of junk transactions to make their activity indistinguishable from background noise. The North Korean Lazarus Group became the benchmark for this, combining mixers, chain hopping, and automated structuring into laundering paths so layered they routinely outpaced investigative teams. This matters to you because when criminal bots mimic legitimate trader behavior, the forensic systems trained to stop them start flagging innocent accounts that happen to trade in similar patterns. Ordinary users have had wallets frozen and accounts suspended because their legitimate activity looks statistically similar to a known evasion technique. You do not have to be doing anything wrong to get caught in that net. NFT wash trading. You create an NFT. It can be anything: a pixelated JPEG, a short audio clip, a digital sketch that took 11 minutes to make. Then you sell it to yourself using a second wallet you also control for $500,000. On paper, you just made $500,000 from art. This is called wash trading. It sounds almost too simple to work, but it does, because NFT values are entirely subjective. There is no market price to contradict you. A single sale sets the value, and you control both sides of that sale. This matters to you because artificial sales inflate the perceived value of entire NFT collections. Ordinary buyers enter a market they believe is active and liquid, paying real money for assets whose price history was fabricated. Blockchain analysts identified one address that executed over 830 sales to self-financed wallets. A group of just 110 profitable wash traders collectively made nearly $8.9 million. That profit came directly from buyers who had no idea the market they were entering was staged. DeFi flash loans. You need $37 million to manipulate a crypto lending protocol. You do not have $37 million. It does not matter. You borrow it, execute the entire operation, and repay the loan, all within a single blockchain transaction lasting less than 15 seconds. This is called a flash loan. It lets anyone borrow massive amounts of cryptocurrency with zero collateral on one condition: the loan must be repaid within the same transaction block. If it is not, the blockchain automatically reverses everything as if it never happened. But if the borrower can exploit a protocol fast enough, they keep the profit and repay the loan cleanly. This matters to you because the liquidity being drained in these attacks belongs to ordinary people who deposited their savings into DeFi protocols to earn yield. In 2022 alone, DeFi platforms received 69% of all funds sent from addresses linked to criminal activity. The $37 million Alpha Homora attack in 2021 wiped out funds that real users had deposited. There is no insurance, there is no regulator, there is no phone number to call. Privacy coins. Bitcoin transactions are public. Every wallet address, every amount, every timestamp is visible to anyone who looks. So after moving $50 million through a DeFi exploit and chain hopping it across 4 blockchains, a forensic team is still tracking it. Then it gets swapped into Monero, and the trail ends there. Privacy coins do not just hide your name. They hide the sender, the receiver, and the exact transaction amount simultaneously. Monero does this using ring signatures, which blend your transaction with dozens of decoys, so no analyst can isolate which output is yours. Zcash uses zero-knowledge proofs, which allow the network to confirm a transaction is valid without revealing any of the underlying data. This matters to you because the regulatory response to privacy coins is already affecting ordinary users. Most major exchanges have delisted Monero entirely under government pressure, meaning anyone who held it for legitimate privacy reasons lost access to liquidity overnight. North Korean hackers were documented in 2022 swapping stolen Ethereum into Monero to break the forensic chain. The crackdown on that behavior is now shaping which financial tools civilians are allowed to use. Peeling chains. Picture a pickpocket working a crowded stadium. He never carries the wallet himself. He touches it for 1 second, passes it left. That person passes it forward. That person slips $500 into a jacket pocket in Section D and keeps walking. By the time anyone checks the security footage, the money has touched 400 different hands across 400 different seats. That is a peeling chain. A large sum moves forward through a long sequence of wallets, and at each step, a small slice gets quietly peeled off and exits to an exchange or ATM. Automated scripts run this process at hundreds of hops per hour with no human manually involved. This matters to you because ransomware payments from hospitals, schools, and city governments are routinely laundered through peeling chains. Every time a public institution pays a ransom to restore its systems, that money immediately starts moving through hundreds of wallets before anyone can freeze it. The blockchain records every transaction. The trail is technically public, but following it through 500 wallets across 3 exchanges requires resources most law enforcement agencies simply do not have. Metaverse and play to earn. A North Korean state hacker moves $7 billion in stolen cryptocurrency. Not through a bank, not through a broker, through a video game. In blockchain-based virtual worlds, users buy and sell digital assets like virtual land, weapons, and in-game artifacts using real cryptocurrency. A launderer purchases those assets with dirty funds, then sells them to a second account they also control. The money moves. The paper trail reads as legitimate trading income. The play-to-earn model makes it worse, because claiming wealth was earned through gameplay is genuinely difficult to disprove. This matters to you because millions of ordinary players participate in these same economies. When criminal money floods into a virtual world, it inflates the price of in-game assets, distorts the economy, and eventually collapses it when the launderer exits. The FBI confirmed the Lazarus Group used exactly this method across Metaverse platforms. The players who lost money when those virtual economies crashed were not criminals. They were just playing a game. Nested exchanges and OTC brokers. You cannot walk $200 million in dirty crypto through a major regulated exchange. They have compliance teams, identity checks, and direct lines to law enforcement. So instead, you find a private broker operating out of a messaging app with no listed address. Think of it like a speakeasy hidden behind a legitimate restaurant. The restaurant has a license, a front door, a health inspection certificate. But if you know the right person, there is a back room where different rules apply. Nested exchanges work exactly like that back room. They open accounts on major regulated platforms and use those accounts as cover, shielding dirty money behind a legitimate institutional profile. This matters to you because the compliance costs of shutting these brokers down get passed directly to ordinary users through stricter identity requirements, withdrawal limits, and account freezes on mainstream platforms. In 2021, the US Treasury sanctioned the Russian broker CUEX after finding 40% of its transactions were linked to ransomware. Its partner ChatX had 50% of all activity flagged as high risk. Every time a nested exchange gets sanctioned, the regulated platforms it piggybacked on tighten their rules for everyone. The back room gets sealed, but the front door gets harder to walk through too.